Hi guys, welcome to the Saving Money Show with me, your host Sean. Today we're going to talk about trading plans, a couple of warnings, and we'll start off with a tip. Now, you may see a new way of recycling in SHUHs. Bring in your old shoes and trainers, and we'll give you £5 off your old shoes. But the problem is there are lots of terms and conditions to that. And don't forget to hit that lovely like button, almost as lovely as me. Helps with the YouTube algorithm and getting the video out to more people. And don't forget to hit that subscribe button if you haven't already. Become part of the Saving Money Show family. We give each other hints and tips and updates about stocks and shares we talk about on the show. As well as that, you can ask me to look into any share you want, and I don't charge a Discord fee or ask for a Patreon. All I do ask is for you to comment in the box below and hit the like button. Even if you disagree with me, especially if you disagree with me, I like a debate. And if I do something wrong, I want you to call me on it so I can improve the channel. And why not check out the links in the description below? There's lots of others. I've used each one of them myself. I wouldn't give you links if I haven't checked them out myself. If you're looking for a free trading platform which should trade your stocks and shares, you can get a free share worth up to £200 for signing up and depositing a small amount. A free trade only requires a £1 deposit. The others require £100 or dollars, depending on which one you go for. Stake has over 3,500 US stocks on their books, which is the biggest one outside of the US. Whereas Trading 212 is one of the best and easiest platforms to use. But as I said, I use all three. Anyway, on with the show. The first being, you can only buy them off full price footwear. It's over £25. They didn't just pluck that figure out there. They realised the average price spent was £15. And full price, and only one pair at a time. So the thing is, if you look in this full price stock, you will find one pair of boots that are £130 that Timberland have on their online store for £65. So beware of some of these deals coming up, especially when we start coming up with a pre-Black Friday deals. Now we're gonna start moving on. We start with, if you're in ExxonMobil, I spoke about selling it before. You can expect it to start dipping purely because there's rumours that it won't be able to sustain its dividend. Now, you are getting people going in because it's cheap, even though it's left the S&P, and they think it's still a good dividend. I understand that, but there are people out there saying it won't be able to sustain it. I don't come at either side of the fence. I took my money out of it because I found an 8% dividend paying oil company closer to home that isn't as reliant on oil. As I said, it was in wind, natural gas and solar as well. So I went for them. I'm sorry about the noise. We are outside. It is a byproduct of being outside in natural light. I do apologise for it. Now we have to move on, and as an example of how important a plan is, because we do have some people who just wing it. We have a Japanese billionaire who laments a $41 million loss. Now this guy, this guy has lost $41 million because he didn't have a plan. And what's his plan? To recoup it all back by trading again. This is from day trading. So when you don't hear about dangers of day trading from us, you know, when you're not listening to us about dangers of day trading without learning how to do it properly, then look at these examples and see from these guys. Now it's yes, the guy's a billionaire. He can afford to lose $41 million. It's still going to hurt him though, and it reminds me of someone that I knew before who didn't do his research, just went into a certain stock because everyone else was going into it, and when he lost his money, rather than pulling it out, he just started coming up with, oh, it'll turn around, I'll make my money back with it. And ended up losing all his money. You've heard me say before how I put my gains and my losses. I'll let you know where I've made my losses. And when I said about my Workhorse gains, I said they weren't really gains, they just offset my losses. So I don't hide anything from you guys. You sucker. And before you go into a stock, have a plan. Now, don't get me wrong, there are times that plan can change. You know, when if you do a review of that stock and the whole reason you got into that stock has changed, but before you get into a stock, make a plan for entering and exiting, whether it's short term, long term, and your entry point, exit point, and what you're hoping to get out of it. Do not just blindly go in thinking everything's going to go up, like the DraftKings guy has been saying earlier in May. Now, we don't want incidents where you guys lose money. The DraftKings guy, this Japanese businessman, they can afford to lose this money, so they can act like idiots on the internet. Sorry about that. Me, I can act like an idiot on the internet when I'm doing my channel because it's my channel, but when it comes to investing, I'm deadly serious. And Fifi Finance, I think, explained it when she said about a finance story. A boy came across an old man who was trying to catch some turkeys. He had some twine, a catch on a cage, and he'd been waiting there all day. Some turkeys wandered in because he'd laid bait, and then eventually he caught 12 turkeys, and he was deciding whether to close the hatch because he could only close it once and go. And while he was pondering whether to try and catch more turkeys, one of them wandered out, and he thought to himself, oh, if I wait, that one will come back in again. But rather than cutting his losses and going home with 11 turkeys, he was trying to make an even bigger profit with the 12 turkeys, and another one wandered out, and then another one, and one by one they followed their friend out, and he ended up with nothing. And he wasted his whole day, no money, no turkey, and waste of the whole day. So you should think of that when you've hit your price targets, the shares still going up, and you start thinking it's that you're going to miss out on bigger profits. If you think it's still going to carry on going up, then why don't you do what I do, which is take out my initial investment and a little profit for myself, and at least that way you're not going to lose anything. And I think a lot of people are under the impression they can either take out all or nothing. Still, that's all for today. I'll see you in the next video. Bye. Now we're heading into stocks that I'm looking at and stocks that are bought today. We're looking at Afterpay. Why? Because it has a new payment system that was set up in Australia and has been come across to the UK and now America, and it's traded on 6 different exchanges, and there's a lot of potential. What they do is they don't charge you for using it. They collect all the data on you, and if you're late in paying, they charge you for that. And if you don't pay it, then you will not be allowed to use their payment system again. And remember, a lot of online clothing retailers use this system, therefore you'll be blocked from all of them, which is why they have only a 0.6% rate of failures. So I'm looking into that. Now, one that I've bought, Euro Commercial Properties. I spotted it today and I took the plunge. High P ratio, yes, and the 21% dividend, yes, but that doesn't come into effect till November. But on deeper dive, I looked into it, and you look at the price to book ratio. Well, book value per share is 3.5 times what it is. So I picked up 7 shares in it, and the book value of that is 2 shares what I paid for, you know. So basically I spent $70 for 7 shares. Sorry, I've said that wrong. Sorry. I spent $70 for 7 shares, but what I got in value was let me see what my maths are like. What I got was I got 245 dollars worth of book value on it. Of course, with these companies, you want to check that they're doing well. Net income of 115 million. Sorry, which has increased. They've been increasing, although it did decrease from 2017 to 2018, and I'll explain later. And because they decided to diversify, and now that diversification is paying off during a period like this. Total liability is 2.1 billion. Total assets 4.1 billion. Cash flow 35 million. Now for free cash flow. Now this is a company that I like because it's not just in the retail. It has a large amount of retail properties it leases out in around Europe, but it isn't just retail. It also has the warehouses and lots and lots. If you look into it, it's just so diverse. It's unbelievable. So retail goes down, you've got the warehouse district, you know, and look at it pretty right now. I expect it to a 2x. A lot of volume throughout Rona. I'm surprised it's not higher. Let me know if you're in this. Now, another one. Mercantile Investment Trust. Now, this one, not quite as lucrative. It's not 50%. It's about 30-40% off its highs. Now, why would I go for this? Well, there's not much information on this if you're going for the financials, but with Yahoo Finance and companies like this, you don't always get. But total liabilities is 183 million versus total assets of 2.3 billion. And cash flow 72 million. Free cash flow 46 million. Now we go back the summary, and if we look down, Motley Fool, how he'd invest if he only had £1,000 right now, and he said how he'd invest into an index tracker, a FTSE 100 tracker fund that should yield 3.5%. And he said the one he'd buy for a starter portfolio would be Mercantile Investment Trust, which gives a dividend yield of 3.4%, and the shares trade at a discount of 5% to their book value. You can read the rest of it at your own leisure. I just think it's well worth it. I didn't put too much into it, I just kind of dipped my toe. Now, you've heard me speak about this in the past. This company, I have gone in not because of a dip, although it has dipped in the last month, but if you're looking, but it hasn't dipped that much, you know, but it is still $15 off its highs. If we look at Motley Fool again, I'm gonna be classed as a Motley Fool fanboy. Oof. Now, it's one of his 3 top dividend stocks. Why? It's a wind farm, basically, and it gives you what, a 5% dividend, and he is classing it as giving you a minimum 5% dividend, and he expects it to keep growing, and he said I'd use it to keep buying the shares. Now, the price to book, which I like to look at, isn't on there. I could go through other sites, but don't have that much time, so just going to go to financials. Remember, I'm doing this all off the top of my head, so don't bash me for not being prepared. 605.5 million liabilities, and assets 2.5 billion. You know, that's like having no debt at all. You know, it's just laughable, really, for a company like this in the green energy sector. Yeah. And a report come out today saying how the UK has to concentrate more on renewables if they're going to hit their zero carbon emissions target. Now, you see that cash at end of period 3 million, free cash flow 121 million because of what's left over. I've gone into it and I think it's a good one to go in there. Now, Tapestry, spoke about it before. Down here, it ran up, I sold, it came back down, it's just gone sideways. I bought down here and it went up, and I was considering, I'm thinking, oh, it's run up a bit, $1 a share in a day, should I sell? And then I thought, no, I'm going to look into it. Why is it running up? I looked here and nothing here, which isn't strange. It isn't always the most up to date. And it's got there how Zacks have ranked it as buy, while its competitors it isn't. Now, I went on some other places that I look for up to date information, and I found out on the final trades been big buying, and CNBC's final trades has been big buying in Tapestry today, and I thought, oh, good. Which means for the next couple of days, it might just be a day thing, but if not, for the next couple of days there'll be a bit of a run up. Anyway, we all know Peloton has its earnings. I've been speaking about this since March. I've been a huge supporter of Peloton. You know, I've been in since $60. Now it's been hanging around the $90 mark because people expect them to do well during earnings. They've got the bike, the treadmill, they've got the mini bike and treadmill, and they're looking into bringing out a rowing machine next year. Look, I think they'll blow the earnings out of the water. No two ways about it. The thing is, people expect them to do well at earnings. This is one where they could blow the earnings out of the water. It could be another crash strike. They blow the earnings out of the water, but it's not enough. It could also be another zoom where it goes up and comes down on the back of earnings. Hard to predict. If you got in at 60 like me, or if you got in earlier, because remember I mentioned it in March, but I didn't get in then because I was getting into other things. Now, then I would suggest taking something off the table, just in case you have a crowd strike moment, depending on how many shares you have. Now, my successes today. Oh, look at that. Now, I sold up here. Not 47, 3337. It came down all the way down here. Look at that. I think I'm going to buy back in. I made $100. I sold 2 shares, $100 on profit in the day per share. You can't complain. I'm waiting to see if the bleeding's finished. I bought some more Apple. I bought 10 shares in Apple. That hasn't moved. I bought 5 at 116 and 5 at 115, but that hasn't moved because the event in the 15th September, I think it is. I don't expect them to come out with the iPhone's going to be delayed. I expect them to come out with news about the iPad. It's going to be all about the iPad and the watch, you know. So that's what they'll be concentrating on. Anyway, hope you've enjoyed tonight's show. Don't forget to leave a comment in the box below. It helps with the YouTube algorithm, and don't forget to hit the like button. It really does help. For those of you in the UK who don't know, we do have the buy one get one free cards, and a lot of places are still doing eat out to help out schemes. But if your area isn't doing them, there's an app available called Good to Go, where pubs, restaurants and all these places, say for instance they've had a carvery on that day, comes to the end of the day, they don't want to throw the carvery away, not allowed to keep it to the next day because of health and safety. They will sell it to you at a reduced rate, perhaps 60 to 70%. So if you're the type of person because of work you go late to a carvery, or upset that you missed the carvery, you can go on this app and find any particular food type near you reduced. It's just a little tip. I like to give you guys tips so you can save some money. Remember, every penny saved goes towards a pound. Every pound saved can go towards a share. So look at it that way. And I'll see you in the next video. Remember, stay safe, stay savvy, stay investing. Goodbye.